All right, I should be recording this both on through Zoom and then my usual method of Camtasia. So we'll see how this works. Let me just make sure this says recording. No, it says it's recording. All right, cool. So I figured it would be a great opportunity, given that we're essentially in the beginning of earnings season, just to kind of go over. This is something that if you go into the if you go into the earnings channel, what I'll be doing just constantly as we get more and more uh, knees deep into earnings season, you're going to see me use this channel a lot. It's the earnings info channel. What I generally do is, we'll post, I'll post a lot of trade. We're going to get to days where we're going to have 15, 20 companies that are reporting that are all in the S&P 500. Of course, I can't trade. Nobody can trade all the names. So you have to kind of just be selective, and really only take the ones that you really like. So I'll go over some of my best techniques for that. But a lot of times I know people will be interested in names that I don't play, so I'm always happy to provide what the historic performance of what a company has done on earnings day. So most of what I look at, I don't want to jump ahead here, but if we bring up, let's say, I'm going to talk a lot about UNH because it reports tomorrow, but we could talk about Netflix as well, even though that doesn't report till tomorrow after the close. But I think UNH is just a good example of like something that I like. Again, so it doesn't mean that UNH is going to work for tomorrow, but I like to look for consistency. So a lot of times what I'll do is I'll post the history, which is this screen print, and what I'm looking at for the most part is basically what the price does, right? I mean, I don't really care, if it's an earnings surprise or whatever. That's nice for kind of analyzing afterwards, but my main concern is if the stock goes up or down, because that's how we make money. We're not going to make money on if the company beats earnings and the stock goes down and we went long, right? I mean, so that's nice to look at to see how the company performs. But what we're really concerned with is what the price does, right, for trading purposes. For trades that we don't have on, sure, we could look and say, okay, will the company beat? What was their guidance? And we can kind of take some notes for those. But really, it's always going to be this column on the right, which is what I'm concerned with. How does the price react to whatever numbers that they throw out there, as well as the earnings, whatever it is, whatever their secret formula is. But something like this, for example, UNH, like it's got a much better consistency of going up after earnings. They just seem to do that, and you'll find that that certain names do that. They have a really good consistency. One that I used to trade a lot that's changed. Now this one I might play for earnings, but look at ISRG. Something has changed here. Maybe the stock has gotten a little bit too expensive. But you can see the last 3 quarters, it's not doing what it was doing. For a while, you had these quarters where ISRG was just beating every time the price was going up. And you'll see that from time to time. Is it they'll switch the chance of them going up or the pattern changes. So that's something that you want to be cognizant of as well. But it's really the last few times that I kind of put the weighting, in my opinion. So I'm going to talk about that, but I wanted just to talk about what I post in the earnings channel. I post the implied move for earnings as well. So these are the things that you'll see me do. If it's a trade that I'll take, I'm going to talk about a little bit about the measured move because that helps me pick the strikes that I want. So let's back up and just kind of start from the beginning and talk about what we can expect for our earnings season. And I'm going to touch upon what I wrote in this weekend's newsletter. So if you got a chance to read that, great. If not, I'll go over that. And by all means, ask questions. You could ask questions wherever you want. If you want to ask questions in Zoom, you could do that. Or if you want to ask questions in Slack, that's fine too. But earnings season, what I normally, trading options and so forth, it gets very difficult. I think last quarter was really surprising in terms of earnings. Uh, I think the expectations were too low. Last quarter for earnings was one of the best earnings season quarters to trade that I've ever seen before, because all in all, what I think the result was, or the reasoning why it was such a good quarter to trade, was because the expectations were too low for a lot of names, and some names disappointed. But for the most part, in some of your leaders and some of your names that we've seen that consistency before, they continue to kind of knock the ball out of the court. So it was one of the better earning seasons that I've seen. So hopefully that continues, but probably the expectations are a little bit different than where they were last quarter. I think that they were really low. I think people were after they heard about, remember what happened last quarter. Nvidia came out and they warned. Apple came out and they warned, prior to the numbers. So they kind of brought that earnings bar down really low, and people were expecting, for things to come out really poorly. So I think that also fed into why the numbers were, why some of the trades worked so well last quarter, and why we saw so many nice upside beats, and names that really blasted to the upside. I don't know if I can go back and look at some of these. By the way, if you're new to Slack, I know we there's some new members that joined us today. I mean, you could go back, and what's nice about Slack is you could go through any of the channels and just kind of get a feel of what we do on a daily basis. But some of the trades, you could see, it's basically, I'm going to talk about the size of what I normally trade. So here's a good example. I'll put my comments in here. Like when Adobe reported a couple weeks back, I said I'm not playing Adobe. May look to buy, and I think it fell on their report. But what else? Let's try to find one that. Just going back a little bit. Yeah, it's been a while. I actually haven't been taking too many of them. Autodesk was implying a 9% move. So anyway, but you could get a feel, and you can go back and in the history, and you could see basically everything that we've been doing, and you could get a feel for it that way. So that was a quick summary of what we saw last quarter for earnings. Again, I thought it was great. I thought it was one of the better earning seasons to play, because the expectations were so low in hindsight. But we actually made a decent amount of money trading earnings last time around. So what does it mean for just? I put a couple bullets in here. What does it mean for everything else? I mean, my bread and butter, as I put in the weekend newsletter, is swing trading, right? I mean, every once in a while, I'll take some day trades in the room too, when the opportunity, comes about. Like today, for example, didn't really think that there was any news or any reason for us to kind of sell off a little bit, other than I think we got a little bit too. I think the market is just a little bit too tight to the upside. We're kind of, seems like we're running out of steam a little bit, and we're seeing this selling off in the first hour of the day. So if you like to day trade, you're getting some really good opportunities right now to kind of not buy on the first 5 or 10 minute bar. And I know this is a little bit counterintuitive, but you could kind of wait it out the first hour. I mean, what time did we bottom this morning? We saw this kind of double higher low that we put in for the day on the S&P futures. That was around 12 o'clock. So yeah, I mean, so again, this seems to be happening more and more often, and I think it's just because the market's a little bit tired, right? Friday was of course different because we started up a lot more, but basically either we try to go higher and we fail in the first 10 minutes, and then kind of come in, and then you can kind of think about adding some risk. But I think it really it's a bit of exercising discipline right now, because I think a lot of traders, they want to come in and they want to start buying right away on their setup. So really having the mindset of scaling in helps as well. If you feel compelled that you have to start trading in the first 5 or 10 minutes. But it's been kind of this repeat for the last 2 weeks where sellers are coming in as a sell program, and then buyers step in after that. So that's, I think, a little bit independent of earnings season, but that's kind of the price action as we're not in the heart of earnings season yet. We're just getting into the beginning of it. But I think this is the kind of price action that you normally see. And why is that? I mean, I think there's some easy reasons behind that. I think that a lot of portfolio managers, right, the big institutions that are doing the buying and selling, they want to see what the data points are going to be before they go ahead and commit a lot of risk. So even their existing positions, they may be doing some hedging. I think option flow is very difficult to read, because that's a lot of what we're going to see, both on people's shorts. People might purchase some out of the money calls to hedge their shorts. They may also be more of a put buyer on their longs so that they can kind of hedge any unnecessary action. I mean, I know from being an institutional trader, people don't want a lot of fund managers. They just don't want that earnings risk, right? That a company comes out and guides lower. So a lot of times what they'll buy is out of the money puts, and it doesn't mean that they're speculating. They're hedging themselves. So we see that kind of flow over and over and over on earnings, and we're going to see more and more of it. That you have to basically look at every trade that hits the tape and say, oh, when does this company report? Oh, it reports next week. So that goes into your thinking of like if you're a trader who likes to follow option activity, that's something that I think has to go through your mind, of what the motivation of some of the trades are on the tape. And then secondly, you also want to think about, hey, if it's a setup that you like, well, how long are you going to keep that trade on for too? Because personally, I don't like to hold swing option trades through the earnings date. That's a completely different trade. Then you've got event risk. The other thing that you also have to think about too is the option pricing. It's going to be a little bit more expensive. Like, so right now, if you're looking to trade Netflix, if you were trading Netflix for a day trade, the options are going to be that much more expensive. So I didn't trade Netflix today, nor did I really even look at it. But I kind of already in my mind, I know that the options for this week are going to be super jacked, because, yeah, the implied volatility right now is over 100 in Netflix options. So, if that's a name that you were trying to day trade, you should be picking up or observing that the option price is so much more expensive than it usually is. Why is that? Because you have a big unknown event. So therefore, the option price is going to reflect that, right? So these are just a little bit of basics that you should know, even if you're not trading earnings specifically, that it's a difficult time. I think a more difficult time these next couple weeks to swing trade. And again, this is something that I've learned over the last few years, being that my specialty is swing trading, that I do less of it. Or I will also do trades that, even like Salesforce. Salesforce has already reported earnings. They're not going to report earnings for another month. Unfortunately, I think they're down on some guidance, but that's, I would think, a one-off. But I will generally look, if I'm going to put a swing trade on, I got to have enough runway that the name doesn't report like this week or next week. This way, I don't have to deal with that with the pricey options. So there's a few different types of earnings trades. One of which you could play via exact event, and that's mostly what's in the earnings channel that's in Slack, right? Those are for the specific event of earnings. But I also do a little bit of what I did with Google. which is looking for a name to possibly run into the event. A lot of times, of what we've seen, probably not so much last quarter, but the past quarters, we would see names like run into earnings. And then by the time it gets, if you were thinking about, well, I'm not going to play this name until we get to earnings, sometimes names would get super, super overbought. So it's like, well, how can you put a trade on up here? Right. So if we look at, and I know this has happened before in Google specifically, but I know it happens in like here, I would say, right? Right. So in Thinkorswim, anytime that you have what is this? The light bulb and the telephone is the earnings. But like here's a good example. I don't even know when this was in the beginning of 2018. Look at what Google did. It went up from 1050 to to around 1200, 150 points before earnings. And then look at what it did after. It gave it all back. So so the reason why I like to have a couple trades on like this is because I've seen it before. I've seen names really make a big move. So so that's why I have a Google trade on right now. Plus, there's a Virgin point of control up here, which I would think would be a great place for that to get up to before earnings. But it's done this a number of times before, that I remember in recent history. But this is probably the most flagrant one where it ran up 150 points before, and then again you see what happened on the earnings day. And I remember saying this on that time. I'm like, I can't play Google earnings after. If you look at the RSI down here too, it got super overbought, and then it went from 1179 down to 1120. So it gave back all that pre-earnings move. So those are the two types. Those are the two types of earnings trades that I like to do, and I will set a couple of those up where I think names will run. I had Amazon on last week, and I decided to kind of abandon that because it just wasn't acting the right way. I still think Amazon, it might be, even though I took off that trade today, I was kind of undecided on entry if that would be a day trade. Well, I didn't know Amazon was going to come back like it did today too. But I still think this is kind of setting up maybe for a trade. So it might be something, if we get a little bit of weakness again tomorrow morning, I'll put that trade right back on for a weekly run. Okay, so let's get in. Let me bring up the newsletter. Oh, let's talk about. So I made this quick one pager for earnings season. So the first thing that you'll hear me always do is calculate the implied move. So again, a great time to kind of do this now is when the market's closed, and this is a very basic calculation, but we'll do this over and over and over. So again, as we're just starting our earnings season, it's good to explain what an implied move is. And you could do this, by the way, for any option. Like if you want to figure out what the S&P, what the options are basically pricing in for this week's move, you could do that. And I know MQ does that a lot with the S&P. He'll look on Friday and say, oh, what is the S&P implying for next week? Is there any skew involved? Meaning, are the puts more expensive than the calls? So there's definitely some value in that. But really, it comes into the earnings move. And so basically you're looking for what the market makers are implying for the percentage move in the stock for earnings, right? And the way that you do that is you look at the front week options if there's weeklies, right? So this month, the April monthly expiration is the same thing as the weekly, right? Because we have monthly option expiration on Thursday. So basically every stock is going to have a weekly this week because it's April options expiration. So what you want to do, and we could do this for UNH, I can bring up on Bloomberg, but you want to take the what's known as the at the money, so the closest to the money, and you want to look at the straddle price. Basically the price of the calls and the price of the puts. So UNH is trading at 230, so we'll look at the 230 strike, and I kind of use, if the bid ask is pretty wide, I will kind of go a little bit inside the ask, right? Because you could probably, you want to go, you want to go like where you think you can get filled. So for the calls, I would say that they're probably, you could get filled around 520. So again, you could either go mid-market or maybe a little bit more to the ask. And then if you look at the puts, same strike, 230 strike. And this one we'll just use plus 490. So when I add the price of the puts and the calls up for this 230 strike, I get it around 10 bucks. So 1010. Right? If we go to the calls. So 1010 and then divided by the stock price, which is, let's say, 230. Right? And that gets me 0.04, and I times it by 100 just to get it into percentage terms. So it's about 4.4%. So that's what the options market maker is implying, that UNH moves about 4.4% for earnings. What did when I calculated it earlier, I got 4.6. So it's going to change. It changes throughout the day, but that's pretty close to what I took at 2 o'clock today. So 4.6, and then the next step that I like to do is basically compute the measured move. Right? So for UNH, price of calls and puts at the money, April options was equal 1010 divided by 320, and that equals 4.4%. Whoops, 4.4%. Okay, so what is the range? Where could it get to? So you're basically doing the stock price 320 times 1.044. And that equals 334. Right? If I wanted to see, now I don't need to necessarily calculate the lower range, because I'm looking to play UNH to the long side. Well, what did I say here? 239. Or no. Sorry, did I do this wrong? I must have done this wrong. What's the price of UNH? Is 230, not 320. Whoops. I knew I did something wrong. So 230. So that's right, and this needs to be changed. We'll put UNH up here. All right, 230. Now, that should be better. Times 1.044%, and I get 240. Is that what I came up with earlier? 239. Perfect. Okay, so spot on. Again, because the implied move is a little bit different when I calculated it earlier. Again, it's a moving, these prices are moving. Right? So what I will then do, so again, you could also figure out the downside one. If you wanted to do that, that would be 230 times 1 minus 0.044. So that would be 1.044 so that's right around 220. So that would be the downside move if I were to play a bearish trade. So this is good because it helps me price the option. Right, so if we go back, because I'm playing this to the bullish side, so 240 is what I expect. So what I like to do is either go right to the implied move, or maybe even go a little bit under it. So what I did for this trade was I did a 232.5, 240 call spread. The price of that is 212, right? And the most that I can make out of that is the difference. So again, most of what I'm going to do here is call spreads, as well as put spreads, as well as maybe sell some premium, which are credit spreads. I'll go over the reasoning in that as well. By the way, if you guys, if you guys have questions or if you're not understanding any of the concepts, please go ahead and ask questions. So this way, we could answer them as we go along. But so what I'll use what the market makers are implying. I'll assume that they're correct with how they're pricing it, unless I think something is really distorted. And I'll basically say, okay, well, let's see if they get it right, and I'll use that to determine my strikes, and that's why I did a $7.50 wide call spread, paying 212, and then of course what I would need the stock to do is get above two. So if I add the lower strike plus the cost of my trade premium, which is 212, so 234.62. So if I did the right, so strikes, I chose using the measured move, April 232.5, 237.5 call spread, and I paid 212. Right. So maximum loss equals $212. Max gain is the width of the spread, 750 minus 212. Again, that's the width of the strike minus the premium that I'm outlaying, which is debit spread. So the most I can make is 538 bucks. 5.38 times 100, 538 bucks. Okay, and then anything above, where I make money is 212. So this strike 232. Which is what, 234.65, 62. I can't do math in my head right now. 234. Right, so anything above there for tomorrow, because they report before the open tomorrow, is going to be 234.62. That's where I begin to make money on that if the stock ends up. Plus, I'll have a little bit of time in the option as well. Okay, so one of the main concepts here is binary, and I'm going to mention this a couple times, right? For these types of earnings trades, so for example, for this one that I do tomorrow, it's usually either win or lose, which is very important, and it's something that you should know is while you enter the trade, that you only risk basically what you are comfortable losing for these earnings trades, right? So if it's going to ruin your day to come in, so let's say UNH, because I don't know what's going to happen with UNH tomorrow. Let's say that they miss, right, and they're moving to the downside, and immediately I'm out 212 bucks. If that's going to ruin your morning, do not do these trades. What I mentioned because of the binary nature, like there's very little trade management. I mean, unless the stock comes in and flat, comes in, doesn't budge at all, then maybe you could think about if you really want to try to salvage something, you could try to do something. But of course, you could just sell it, and just say, hey, the stock isn't doing what you wanted it to do. But there's no I just want to make that very clear. If you come in and the stock is down 5%, and you're like, oh geez, I don't, what am I going, what, how are we going to salvage this trade? There, there's no salvage of the trade. It's it. I mean, that's the binary nature of the trade. It's not like putting a swing trade on for a couple months. But I get this question all the time, and I've seen traders like, oh geez, I just lost 200. Well, yeah, I mean, that's the nature. And if it happens to move to the upside, boom, you make $500 on the trade. And if that's not comfortable with, for your type of trading, that's perfectly fine. You just kind of avoid these types of trades. So, and I know there's some traders in the room that don't trade earnings. They just don't like to have that binary nature, and it's perfectly understandable. So, if it doesn't meet your criteria of risk profile, I would suggest stay away from these trades. The other thing is, and this is for example for me, how much do I want to risk? Well, it's so considering that you could basically lose 100% of the premium that you put in the very next day. I will only basically do, my average swing trade is probably around $2,500 to $3,500. It gets up to, or it's, sometimes it's a little bit more than that. So you can kind of take the benchmark that I like. If you're unfamiliar with this type of trading, you could basically use the benchmark of how I use. So now some people like to risk more than this. If you're really good at earnings and you understand this concept, then maybe you want to risk more if it's something that you've had practice with. Again, it's completely your own profile, and if in your mind, if you're okay with that loss, that you're going to do 20 or 30 of these trades, and you're okay with the risk profile, then of course you can risk more. This, for me, I like to only do risking about 10 to 15% of my normal swing trade because that's my comfort level with these trades. And again, it's not my on the totem pole. Earnings trades are not my best trade. Swing trades are. That's what I like to do. But I realize for the next couple of weeks, swing trades are going to be difficult. So I'm going to participate, and I'm going to do it on a smaller size. And then, of course, and if you think about it intuitively, swing trades, you have a lot more bumper room to, either cash, which of course is, I think, not as volatile if you're trading regular equities, or if you're going out several months, like 3 to 6 months in your option swing trade, you do have that bumper room where you're not going to lose that much, unless something really goes wrong on the trade right off the start. So you can, of course, stop yourself with that. But yeah, I mean, that's mine. That's my usual threshold. Sometimes if I really, really like a trade, I'll go above that. Sometimes if I just want to participate, I'll only risk $100. And that will all depend on the setup for me too. So if it's just something, so for tomorrow, for example, for Netflix, I'll probably just want to participate just a tiny bit. Because I don't really feel like there's a lot of edge in Netflix for tomorrow. So I'll probably devise like $100 or $150 trade. Just so that I'm in there to participate. And if Netflix does something really cool, maybe I can make $500 on something where I'm risking 100 or 150. But I really don't want to risk much more than that because I don't think there's much more edge to that. So I think it's good to kind of start with that. How much do I want to risk? I could talk a little bit about credit spreads and debit spreads, but I wanted to go into my philosophy of trading earnings. So anybody have any questions first just on those basics, the basics of how to do the calculation, the binary nature, anything that we covered so far, and then I'll move on to what I kind of look for. All right. So going back, so I don't see any questions, which is fine. So we'll go back to what I look for. Now this UNH, I do like to look at the chart, even though I think charts probably matter a little bit less for probably a lot less for earnings trades than for your regular swing trade setup. It's new information, and even if a stock looks great going into earnings, was there a Virgin point of control taken out for UNH? No. Yeah, the chart just needed to adjust. I didn't think there was one. I mean, this looks like it's breaking down. So I personally like. So here's the difference between taking a swing trade versus a earnings trade. Would I really want to take a swing trade right now in UNH? No, I don't. It's broken support. It's in this big long trend. Oops. It's been in this big long uptrend, and it seems to have broken. So, it could do a lot of different things on earnings. It could bounce back up to overhead, overhead resistance. It could also break down further. It's not really going to tell me that much. The charts. I think for the most part with the charts, what I usually look for is if a name has been in consolidation for a while and hasn't done anything, that could mean that it could be setting up for a big move, up or down. Like, so for example, Square. If Square stays here for another couple weeks, I have to think that this Square is going to move pretty big because it hasn't done anything. It actually hasn't done much since the last earnings report. But I think that is a good setup too. And again, you have to pick the right side because they could set up for a big move in either direction. But something where it's been in a big period of consolidation usually means that once that new information comes out, it's probably going to move pretty decently. I think the probability is higher that it moves pretty decently. So that's what I'll look for. And just like I mentioned with Google, if something is super overbought going into earnings, then odds are I'm probably not going to take it. I'm just not going to press, even though I like the company and it's got good earnings history. So these are the things that I like. It's a kind of a multi-factor approach that I'll look at before I actually take a trade. So for example, once we get to Google earnings, let's say hypothetically that they have great earnings history, where for the recent quarters they've just done a very good job, but the stock is way overbought going into earnings. I'll probably skip it because I don't think that there's that much edge to go to the upside. And then conversely, if the names really has sold off a lot, I mean, look at JP Morgan, for example. I don't know if it really gave much of a signal. It wasn't overbought, but it certainly hasn't done anything since earnings. So probably set up for a little bit more attractiveness going into earnings. The reason why I didn't play JP Morgan in particular was because these banks don't normally do much for earnings. Where did Citigroup end today? Flat. Right? So there's a reason why sometimes that the market makers are implying very little move, and that's good to look at as well. So if we bring up Citigroup, I think I should have rebooted my